The phrase maximum profit with minimum risk sounds efficient, but markets do not offer that contract. Higher expected return normally requires accepting some combination of price volatility, uncertainty, illiquidity, or permanent loss risk. A better objective is to earn the highest return you actually need, with a drawdown you can survive and a plan you can keep following. This film is general education, not personal financial, tax, or legal advice. In July 2026, the International Monetary Fund projected global growth of about 3% for the year, while warning that disinflation had stalled and that geopolitical conflict and financial market repricing remained downside risks. That mix matters because the same portfolio can face growth shocks, inflation shocks, rate shocks, and liquidity shocks. A hedge should therefore be tied to a named risk, not to a vague feeling that markets look expensive. Start with a one-page portfolio charter. Write down the goal, target date, annual cash needs, emergency reserve, acceptable temporary loss, and the largest permanent loss you could tolerate. Separate money needed within 2 years from money that can compound for 10 years or more. Your investment horizon is not your age. It is the date each dollar must become spendable. Finally, remember the mathematics of recovery. A 20% loss needs a 25% gain to break even. A 50% loss needs a 100% gain. Risk management is not about eliminating every decline. It is about preventing one decline, one concentrated position, or one forced sale from breaking the compounding process. That is the return risk contract for 2026. Build the portfolio in layers. First is liquidity, cash or short-term, high-quality instruments for emergencies and near-term spending. Second is stability, high-quality bonds matched to liabilities, including inflation-linked bonds when inflation is a meaningful risk. Third is growth, broadly diversified global equities. Fourth is a small diversifier sleeve used only when you understand its behavior, cost, liquidity, and tax treatment. Here is an illustrative balanced growth mix, not a recommendation. 55% diversified equities, 25% high-quality bonds, 10% liquidity, and 10% diversifiers. The exact numbers matter less than the job assigned to each sleeve. Equity compounds long-term purchasing power. Bonds may soften some growth shocks. Liquidity prevents forced selling. Diversifiers should address a risk that the first 3 sleeves do not. Use a core and satellite design. The core can be low cost, broad, and difficult to disturb. Satellites can express a high conviction theme, but each one needs a size limit and an exit rule. A portfolio holding 20 technology funds is not diversified if every fund depends on the same earnings cycle. Look through fund labels to the underlying companies, countries, currencies, duration, and credit exposure. Capital weight is not the same as risk weight. A long-duration bond position can contribute more rate risk than its percentage suggests. A volatile thematic fund can dominate total fluctuations while remaining a small slice of capital. Review concentration by issuer, sector, country, currency, and economic driver. Diversification cannot guarantee a profit, but it can reduce the chance that one forecast determines your financial future. A portfolio drifts because assets grow at different speeds. Rebalancing restores the intended mix and the intended risk. Investor.gov describes 3 practical methods: sell overweight assets, buy underweight assets, or direct new contributions toward the underweight sleeves. The third method is often the least disruptive because it may reduce trading and tax consequences. Choose a rule before markets become emotional. A calendar rule might review the portfolio quarterly and trade only once or twice a year. A threshold rule might rebalance when a sleeve moves more than a fixed number of percentage points or a fixed percentage of its target. The threshold should be wide enough to avoid constant trading, but narrow enough to stop one winner from silently becoming the portfolio. Then add a risk budget. Instead of asking only, how much money is in equities, ask, how much of my possible loss comes from equities, rates, credit, currency, and concentration? Estimate a normal drawdown and a severe drawdown for every sleeve. The estimates will be wrong, but the exercise reveals whether several holdings are different names for the same risk. Do not turn rebalancing into market prediction. Raising an allocation because it is hot or abandoning it after a fall replaces a rules-based plan with performance chasing. Review the plan when goals, cash needs, horizon, or risk tolerance change. Before every trade, include spreads, fees, taxes, lockups, and the possibility that a hedge becomes expensive exactly when fear is highest. Good rebalancing is quiet portfolio maintenance. Hedging begins with the cheapest layer, resilience. A cash reserve is not designed to outperform equities. Its job is to stop a job loss, tax bill, or market decline from forcing an untimely sale. High-quality short bonds can support near-term liabilities. Longer duration government bonds may help during some growth shocks, but can fall when inflation or interest rates rise. No hedge works in every regime. Inflation-linked bonds can address unexpected inflation, while commodities or gold may diversify certain inflation and geopolitical shocks. Their prices can still be volatile, and neither is a guaranteed crisis hedge. International investors also carry currency risk. Hedging part of a foreign bond allocation may reduce unwanted currency noise, while leaving foreign equities unhedged can preserve useful currency diversification. The right decision depends on the liability currency. Futures and trend-following strategies can hedge certain market moves, but leverage, roll costs, basis risk, and liquidity make them specialist tools. The Commodity Futures Trading Commission defines a hedger as taking an offsetting derivatives position to reduce adverse price risk. The key word is offsetting. A trade that adds a new, unrelated exposure is speculation, even if it is labeled a hedge. Use a hedge map. Name the risk, the exposure amount, the instrument, the expected behavior, the cost, the failure mode, and the exit trigger. Measure hedge ratio against the exposure, not against the whole account by habit. Correlations can change under stress, so combine layers rather than trusting one magic asset. The strongest hedge stack is often liquidity, diversification, position limits, and only then a carefully sized derivative. Options can make a downside hedge more explicit. A protective put gives the buyer the right to sell an asset at a chosen strike before expiration. Imagine an index at 100. Buying a put with a strike of 90 creates a floor near 90 before subtracting the premium and other costs. If the index rises, the put may expire worthless. That is not necessarily failure. It is the insurance premium for keeping the upside. A caller can reduce that premium by pairing the put with a sold call. The trade-off is clear. The put limits some downside, while the call caps some upside. Choose the protected amount, strike, expiration, and premium budget from the risk you are hedging. Repeatedly buying short-dated protection without a budget can erode compounding. Waiting until volatility explodes can make insurance unusually expensive. Investor, if puts reduce losses, why not hedge the entire portfolio all the time? Advisor, because protection has a cost, expires, and may not match every holding. First decide which loss would break the plan. Investor, can I fund the hedge by selling naked options? Advisor, that can create losses larger than the premium received. A risk management trade should not introduce an unlimited or poorly understood obligation. FINRA warns that options are complex, leveraged instruments. Buyers can lose the entire premium. Sellers can face assignment, and uncovered calls can have theoretically unlimited loss. Brokerage approval is required, and time decay, volatility, liquidity, tax treatment, and contract specifications all matter. If you cannot explain the payoff at expiration, the maximum loss, the assignment risk, and the exit procedure on one page, the position is not ready. Before funding the portfolio, run simple stress tests. Use hypothetical scenarios, not forecasts. Global equities down 25%. Interest rates up 1.5 percentage points. Inflation 3 points above expectation. the home currency down 10%, or a liquidity freeze that widens spreads. Estimate what each sleeve, each hedge, and the whole portfolio might do. Then ask whether you could still meet near-term spending without selling growth assets. Create a small dashboard. Track allocation drift, single position concentration, estimated portfolio volatility, liquid months of spending, credit quality, duration, currency exposure, hedge premium spent, and upcoming tax events. Do not optimize every number daily. Use the dashboard to detect a broken assumption or a position that has grown beyond its assigned job. Turn the plan into operating rules. Keep the emergency reserve separate. Automate contributions into underweight sleeves. Review quarterly. Rebalance when a pre-written threshold is crossed. Require a written thesis and maximum size for satellites. Require a named risk, budget, expiration plan, and failure mode for every derivative. Record why a hedge was opened so that fear does not keep it alive after its purpose disappears. A sensible implementation sequence is: define liabilities and goals, establish liquidity, choose a diversified strategic allocation, set contribution and rebalancing rules, cap concentrations, stress test the result, and add only the smallest hedge that addresses a remaining unacceptable risk. No portfolio can maximize profit and minimize risk at the same time, but a portfolio can maximize the probability that you stay funded, avoid forced decisions, and keep compounding through an uncertain 2026 and beyond.